released their annual report a couple of days ago, and we had a bunch of analyst notes that came in as well. This morning, it's from DAM Capital, which says that they believe that the recent stock price correction offers an attractive entry point as against all the competition coming in from Campa, etc. They have a fair amount of capacity headroom, not just in India, but the Africa business for them ramping up as well. So a big cut from the highs we saw in Varun Beverages. This may well be a stock to buy the dip on.
All right.
Up 20% in this month when the market's been correct. Varun Beverages.
Down 40% from
summer is coming, and you know, you need the cooler stuff. We got market open 22,645, 22,650. So, you know, the first things first. We've now once again for the second time we are back above the 20-day moving average. Yesterday there was a throwover, but then the market ended under the 20-day. But this morning, 22,600 plus. So that's a good start. The Nifty Bank is even better, 0.6% higher. It's private banks. It was yesterday as well. It was the private bank space which was buzzing. And I suspect that's again the case this morning, powering the gains as far as the Bank Nifty goes. The Midcap index is up about 0.5%. And I think you've got the small cap index, which will come up on your screen, which should also be higher. Lots of stocks at the bottom of the screen in terms of what's starting up. There's one lone name in the red in the Nifty 50. The heat map is coming into view. 49 up, 1 down. And as I've been saying, the market has been trading much better last few trading sessions. Looks like at the margin, don't want to jinx it, but maybe price-wise perhaps, you know, hopefully a bottom is in. And of course, what it does from here is another question. What shape, form, how fast? We'll see, but 22,600 plus as far as the start goes. Let's get to stocks. Surabhi.
Well, it's pretty diverse today, and it's not just one sector or, you know, one set of stocks that's taking the market higher. Metals are definitely shining bright. Hindalco is the top gainer on the Nifty, 2% higher. Financials are very, very strong. Financials, banks and non-banks put together are the smartest trade this morning, you'd have to see. Bank Nifty is up almost 0.8%. ICICI Bank, Axis Bank, these are gainers above 1%. In the non-banks, we've got Shriram Finance. Let's also talk about, of course, the stock of the moment because of the news flow, which is Bajaj Finserv and Finance both. 0.5% up on these two for the timing. I just want to check what Jio Finance is doing. If there's any excitement around Jio, let's get that stock up on the screen as well. About 0.7% higher. That's Jio Finance. Beyond the financials, by the way, Shriram Finance as well, up about 1%. You'll hear from the company as we go along in the show. HDFC Bank is also contributing, and so is IndusInd Bank. So financials looking very good. But beyond financials, there's Reliance, there's L&T. So there are plenty of legs to this move that we are seeing this morning. The only actually slightly sobering spot is technology. Once again, big concerns around what's happening with the US. HCL Tech, TCS, Infosys, these are your stocks on the way down. But barring these 2-3 names, it's actually a very green-looking Nifty screen.
You know, Prashant said that from a price standpoint, we perhaps have made a bottom. And every time we do that, it's the mid and small caps which actually outperform because the street then becomes a lot more risk-taking. And we have, exactly that playing out. 1,700 stocks in the green. Remember, we opened with 1,300 stocks in the green. So that ratio is firmly in favor of the gainers. And look at the bunch of stocks that are gaining today. We have Ircon. They, the joint venture won an order worth 1,100 crores, of which the company's share is just 285 crores. Stocks up 7.5%, almost 8%. Not a very big order win, but an order win nevertheless, enough to take the stock higher by 8%. You have NBCC. Again, just a 45 crore order that the company has gotten, regular course of business, but that stock has been well bid as well, 2.5% higher. Manappuram, board meet on March 8th to consider fundraising proposals. Is Bain coming in or not? That stock up around 1.5%. Senco, this morning we had the management join us say that they bought shares worth 4 crores in the market yesterday, perhaps are likely to buy today as well. What has the street done? 5% upper circuit on that stock as well. The only one stock which is lower, notably with reason, is International Gemological Institute. Remember, seen a big cut from the highs itself, from the IPO highs, and now the stock down 5%. The anchor lock-in opens today, so maybe more supply coming in on that stock, likely to be underbid in today's trading session as well, so down about 5%. But by and large, the mid-cap screen looks like a very bright green.
Absolutely. 100 points on the Nifty is what we have. So holding above the 22,600 level. Just a few other names with very large volumes. Ircon, I think Mangala mentioned that, 7%. Varun Beverages is the number 2 biggest volume-led gainer. It's a 3% pop. MobiKwik sold off sharply yesterday. It's about 4.5% higher. recent listing, Blue Jet is up 3.5%. You got Triveni Turbine, which is up 3.5%. Motilal is up about 2.5%. Car Trade is up 2.6, 2.7%. And I think PVR Inox is coming up with about a 3% again as well. 361, the wealth manager, 4% higher. PG Electroplast. Senco is now limit up. Senco is up 5%. Yeah. The manager was telling us
But they're buying more shares apparently in the market today, they were
so
saying.
maybe we don't know who's buying that is, but stocks up. You got Sula. Sula has got a 7% gain. 265, completely bombed out name, but 7.5%, 8%. And there is NetWeb, which is up about 4% as well. It's a good-looking screen. 1,850 stocks are higher, about 400 stocks are lower at this stage. We'll talk more individual names, but let's get a broader flavor and idea of what's happening out there in the market. Mihir Vora is with us in the studios now, Chief Investment Officer at Trust Mutual Fund. Mihir, good to have you with us here. Good morning.
Good morning.
So price-wise is a bottom in. What's your sense?
I hope so. I think so. We've had a lot of pain, and the small cap index, for example, was down by 25%, but before we realize it, it's almost up by 8 to 10% from the bottom. So markets, correct very sharply. The rises are probably a bit more, measured. But you got to do what you got to do.
Stay as an elevator.
Stick to your convictions.
So where are those convictions now, Mihir? And has anything changed in this 5-month long sort of recession? Not recession. What am I saying? Correction. Imagine that. That's how the mind works, right? When you hear so much of negativity, recession, correction, all the words kind of mix up. But they also say that every time you have a new phase of a bull market, if at all we're entering one, the leaders are different. So in terms of your conviction, what has changed and what remains the same?
Sure. So just like to spend a minute on, what happened exactly. The point is that part of the correction was justified by valuations. Part of the correction was justified because of slowing fundamentals. And we probably took a little longer to realize how sharply the government, cut down on spending in the first half of the financial year, right? So the government spending, especially the capital expenditure part, it was much sharper. The cut was much sharper than expected, which impacted stock prices, in those segments the maximum. Second is the RBI also kept things tight. And third is the dollar, right? Now, I think all these cyclical factors are coming to a positive territory, I would say. And if you step back and think, now in the June 25 quarter and the September 25 quarter, we actually have a much lower base to start from.
Earnings.
Earnings as well as top line. Even if government spending comes back to normal levels, you have almost a 20% YOY increase in Capex in the June quarter and the September quarters coming up. So we have a good favorable base effect in valuations. We have a good favorable base effect in top line as well as bottom line. So I think the next couple of quarters, you can actually see good numbers on a year-on-year basis. And then if the momentum sustains, then you actually have good momentum even without a low base.
So from an investment standpoint, the obvious question is that should you now look at aggressively buying or should you look at selectively buying? And if yes, for aggression, what sectors? If yes, for selection and capital protection, what sectors?
Sure. I think the sector that needs to drive the market has to be financials.
Yes.
Because we've discussed so many times that the valuation equation as well as the growth equation seems to be in favor. And balance sheets for most of the large NBFCs and banks are pretty clean. So if we are on the back on the growth path, then I think financials should lead the pack, so to say, especially in the large cap and the diversified indices. In the small cap and mid cap indices, the financials weightage is much lesser, but they will drive the diversified and the broader indices.
Anything that you specifically bought, not necessarily in financials, but in this big correction that we saw? You said that the small cap index, before you blink, was up 8% from the lows as well.
Correct.
Did you benefit from any of those declines?
I mean, we don't take big cash calls, frankly. So we were, anywhere between 90 to 92% invested in any case. So there's not much churn that we did. But in the diversified fund, we did increase exposure to the financials, both NBFCs as well as banks. But we are still sticking to the larger ones.
Okay, so larger financials.
Yes.
That's one aspect. Coming back to and since you're saying that now, you explained the base factor, right? That government spends anyway will start looking better because of the base factor. What is your stance now on the Capex side of the market? That was the previous leader, which is why I come back to that question, saying, will previous leaders continue in this phase or will they kind of give way to someone new?
I think they will continue because this story that we talk about is a multi-year story. It's not about only this quarter or next quarter. The government has to spend. The private sector has to come in. The government is rolling out PLIs. We have to indigenize defense production. So all those themes have not changed. We need massive investments in distribution for power generation because of the thrust towards renewables. Renewables targets are being scaled up. So all those themes were macro-year theme, multi-year themes to start with, and they will continue. And stock prices are down like 40 to 60% in many of these segments. So I think that will definitely continue. Probably financials, which lagged almost for 1.5 to 2 years, should now not lag that much and actually maybe lead the pack a bit. Okay. So maybe the kind of multi-bagger returns that you saw between 22 to 24 in some of these segments, the Capex segments, may not be there because even after correction, they are at normal valuations, but you will still see them outperforming.
Earlier, upmove was expected to be Capex-led, and now post the budget, people are talking about consumption. There is a recovery in rural consumption. There is expected recovery in urban consumption. Where do you stand in the consumer stocks?
I think FMCG will continue to underperform. I mean, it may do better than what it itself used to do, but it's still a boring number.
Okay.
Because most of these categories are well penetrated, 80-90% penetrated. And I was just looking at one of the studies that Motilal Oswal did on the institutional equity side. Most of the large cap FMCG stocks have less than 10% CAGR in turnover over the last 10 years, right? So even if you remove all the seasonality and cyclicality, we are talking about maybe single digit or low double digit kind of a growth number, which is not what we want in our portfolio.
Okay.
No, got that. By the way, Amir, with full disclosure, and of course not asking, would you want to name one or two, I mean, a few ideas in the small and mid-cap space where price damage has been quite a bit. How are you thinking about, what kind of framework are you building when you look at names, businesses? Because just simply price damage cannot be it, right?
Absolutely.
So just to give us a sense, maybe one name and just to kind of sort of build the thesis around it.
Sure. I mean, name is not possible, but we have always been saying that the domestic economy makes more sense to play than the global economy, and we have been mostly underweight on large cap IT stocks, for example, and we've been mostly bullish on the domestic themes. Within the domestic themes, as I said, we were kind of underweight on the financials till now, more on the Capex and physical asset creation side. So that means capital goods, infrastructure, construction, railways, defense, those kind of themes, which we continue to be overweight on. And then specific stock picking in the healthcare segment. So within healthcare also we have generics, we have CDMO, we have the hospitals, and we also have the diagnostic plays. So across healthcare also we are overweight. So we are structurally overweight on industrials and the physical asset creation, including real estate. We are structurally positive on the healthcare segment. Typically, that's what we tend to do. But now, incrementally, as I said, I would play more of the domestic financials.
You speak about real estate incrementally. We've seen an upmove come by on Aditya Birla Real Estate. Remember, the company has launched a project, their first project in Pune, eponymously named Punya, Aditya Birla Punya, and they expect sales in that business to come to around 2,700 crore rupees. So AB Real Estate up 4%. The street takes note of that. On real estate specifically, where in the cycle do you think we are? Because at one point the prices were going extremely high. This is flat prices that we're talking about. Now, there are pockets of problems in the entry and mid space, whereas luxury continues to do okay-ish. Where do you think we are on the real estate space, and what sectors would you back? Would it be Bangalore, Hyderabad, Bombay or Delhi?
In real estate, I would not really play for price appreciation anymore in most of the market segments, because we have seen good price appreciation in the last 3 years in most of the segments. But volume growth, especially for the organized players, I don't see a problem. Because even now when quality builders are launching projects, they are getting lapped up. There might be a bit of a froth in the NCR market, especially the Gurgaon, where things are a bit wonky. I don't know how much is bookings and how much is genuine sales there. But in general, I think volume growth is something that we need to play for. And as you mentioned, the affordable housing still needs a bit more push, I guess. It's not the strongest segment. We still continue to be in the K-shape of the real estate space.
You mentioned financials, so I just want to come back to that. By the way, just let's pull up the stocks as well. Bajaj Finserv, and I think in finance, they have now turned slightly lower. That's the situation. Look at the other life insurance stocks as well. Pru, Lombard, there's some green over there. SBI Life also started out positive. Let's talk about the non-banks, because you're positive on overall financials and what makes sense to you over here. with insurance, the thing is that there are so many regulatory changes. Every quarter you run into something from IRDAI or something on taxation, which kind of, truncates the wider move. But we know there's commitment in this deal. I mean, this morning's deal tells us that there is serious money being put to work over here. What do you like in non-banks?
So in non-banks, we've recently, not recently, we've basically always been positive on the capital markets theme.
Okay.
Of course, that theme has taken a beating for lots of reasons. First of all, in some of the exchanges, etc., because of regulatory changes, volumes have come down and all that. So we have seen stock prices take a beating. But now they've, I think, formed a good base in any case. So structurally, in the capital markets theme, because we think the savings pool will continue to increase. So everything linked to the savings pool, which is wealth management, broking, asset management, and then of course you have more trading, etc., exchanges, etc., mutual fund distributors, for example, they'll continue to do well. They will continue to grow at a rate which is faster than the rest of the financials. So structurally, I think the capital market segment will grow even faster than the lenders.
And the vagaries of the market don't worry you, because typically the sentiment is that the stocks will fall every time the market falls.
They will be pro-cyclical.
Yeah.
They'll be high beta in the direction of the market. But point to point, if I were to take a 10-year view, I think they will
overall it will give you better returns. And what about lenders? You're saying some of these capital market plays will outperform, let's say, lenders
over the longer term, but they'll be high beta.
But in lenders, because it's not a paint everybody with one brush situation anymore.
Correct.
So what is governing your stock picking when it comes to banks?
Absolutely. So as I said, in the lenders, I'm bullish both on the NBFCs as well as the banks. NBFCs probably in the shorter term might benefit more by the rate cut cycle, because most of the NBFC lending is fixed rate, again, as compared to the banks, which is floating rate. So when rate cuts happen, the bank's asset book will get repriced faster downwards. The liability book will take a little while to, so they might not be able to improve their margins immediately. But NBFCs, because their borrowing costs can come down sharply immediately, they can improve their margins in the shorter term. And plus, the RBI had been really coming down heavily on the NBFCs last year, which they are now easing.
They have some reprieve.
So they have a bit of a regulatory tailwind also.
What about hospitality? We've been speaking about, that being in a cyclical uptrend, also demand-supply dynamics favoring the industry, unorganized to organized, and all FMCG, yes, under-penetrated, but consumer discretionary doing a lot better, and hospitality is one of those spaces.
Absolutely. So, the K-shape continues in the economy, while rural is catching up. I think as far as growth rates are concerned, all the premium segments will continue to, whether it's hospitality or airlines or, hotels or even your high-end jewelry, for example, watches, high-end cars, SUVs versus cars. So that, I think, theme will continue.
Mir, pleasure having you with us here. Thank you very much for joining us.
Thanks for having me.
Appreciate your thoughts, as always. Now, let's focus on the big story from last evening, right? Which is, of course, the Bajaj Allianz separation, in that sense, after actually decades of working together. And my colleague Yash, of course, has been tracking this for the past many months now. This finally happened. And Yash is now picking up some more plans with regards to what Bajaj Finserv's what Bajaj Finserv wants to do with both the life insurance and the general insurance entity. Yash, good morning. Take it away.
Good morning, Prashant. So, of course, with this particular announcement of the transaction, one thing which is clear is that Bajaj Finserv and its promoter companies will have 100% ownership of Bajaj Allianz General Insurance as well as Bajaj Allianz Life Insurance. What that does is it gives them freedom in terms of what they want to do with that 100% ownership, a lot more flexibility. Now, a natural question was, of course, that after, a termination of this JV with Allianz, would Bajaj Finserv go out and look for another investor, a like-minded investor, to bring in capital as well as expertise in both the JVs? What we've been given to understand from our sources is that the intention is completely opposite of that. In fact, Bajaj Finserv does not want to get any new investor, strategic investor in the life as well as the general insurance JV. And the intention is to have it owned entirely by Bajaj Finserv and its promoter group companies, essentially Bajaj Group. But, over a period of 1 to 2 years, the intention is also to unlock some value out of these two entities. And the way to do it, as per the company's consideration, would be to look at a public listing of both life and general insurance entities. But at the same time, there are a lot of moving parts in terms of regulations at this point of time. So any potential listing, as I've been given to understand, would only be a FY27 event. The valuations we have, Bajaj Allianz General Insurance, the deal values the company at over 53,000 crore rupees, the life insurance entity at over 40,000 crore rupees. So combined valuation at this point of nearly about 1 lakh crore rupees.
All right, take that point. Yes, thank you for bringing us up to speed with all the developments out there. We will, keep an eye out on Bajaj Fin and Bajaj Finserv. But the stock on our radar, the sector on our, radar right now is the paint space. Brent crude prices are contained around that $71 per barrel. Will this impact margins of paint companies? How's demand holding up ahead of, any sort of up move that we'll see in terms of urban demand as well? Abhijit Roy, who's the Managing Director and CEO at Berger Paints, joins us now. Abhijit, this paint space always buzzing, right? Right now, it's raw material prices which are contained. That should bode well for your margins. But in light of competition, are you passing all of that value to consumers and perhaps, keeping your market share intact as well? The question, so many moving parts, right? How has demand been in the fourth quarter so far? What are your expectations in terms of volume growth, volume value equation and margins?
So, good morning, Mangalam. And yes, there's been some improvement, as expected. We had indicated that quarter 3 was better than quarter 2 and quarter 4 is likely to be slightly better than quarter 3. So that trend continues, and we expect that the volume growth will be in high single digit and value growth will be in mid single digit. The gap which was there earlier was almost 6%. That gap will get narrowed to about 3% from the volume and the value. So that is how it looks like in quarter 4. Demand is not, very strong, but it has picked up definitely from what it was in quarter 3. So there will be a marginal improvement, therefore, in the value growth. As far as profit margins are concerned, we haven't passed on anything because these profit that you are seeing, in terms of the raw material prices going down because of the oil prices going down, that takes time to filter down, because immediately it doesn't happen. Some of the raw materials do get impacted immediately, but most of it takes its time. So as of now, there's been no passing down the profit margin. So it will possibly be retained a little bit, whatever comes this quarter.
So what would your EBITDA margins in the fourth quarter be?
Slightly better than what it was there in terms of quarter 3.
Okay, 15.9% is what you did in quarter 3. I just wanted to get a sense of how much better they would be in the fourth quarter and if you are releasing any targets for FY26 on volume and profitability front.
So it should be better, second half specifically in financial year 26 should, be better than what it has been this year. This is the expectation. In general, we expect the consumer demand will pick up next year. As you know, all the FMCG companies, including, paint category, has been impacted by a little bit, headwind in terms of demand scenario. Government has taken some action. We need to see, from April onwards, whether the demand really does pick up and to what extent it picks up.
What about competition? There is a lot happening. We've been speaking about Birla Opus. They did their first festive season. Relatively resilient on the east side is you because they didn't have as much presence. But now they are planning to, open their plant in the eastern part of the country as well. Chances are that there could be further intensified competition in areas that you operate in. What are your thoughts on that? And what are your feelers from the ground on their product quality, on their distribution strength, and what they've done so far in the festive season?
So they are, I would say a player who's serious, in the paint industry, and therefore, there's no doubt that they have some presence built up now. As far as the East is concerned, they are already there across locations. I don't think factory coming in is going to add significantly to whatever they are doing today. Largely because, the paints are coming from different locations, north, south, east, west. If you look at even the leader, which is Asian Paints, they don't have a factory in the east, but they are, quite strong as far as the eastern market is concerned. So it doesn't matter actually, whether you open the factory immediately or, we have in fact 2 factories, but that doesn't make us, the clear leader here or something like that. So we are strong, definitely. And, we are there in this place, for a long time. We have our own strengths in terms of brand equity, in terms of distribution network, in terms of our relationship with painters, applicators, builders, architects. So that will hold true. I don't see that changing, in any significant way just because the factory is going to be built. As far as Birla's performance is concerned, they have been saying that, they have large network now on the ground, which we are tracking, and we see that, network expansion has happened. As of now, YTD basis, they have about 3.5 to 3.8% market share. Which is likely to, if you look at the monthly run rate, maybe it is about 5 to 6%, in terms of market share. So that is how it is placed. Some of it has come from the organized, some of it from the unorganized. As far as we are concerned, even though there has been 2 headwinds this year, 5% in terms of price drop, which we had to face this, plus, the competition from the new entrant. In spite of that, we are still growing, so next year when, the 5% goes away and the competition intensity will remain, but possibly, it will be muted than what it has been this year. So we expect that the growth rate for us will continue.
Mr. Roy, hi, sir. Great to have you on the show this morning. Just 2 quick questions from my side. One, given this prolonged period of, of pain and pressure, slower volumes, just curious, what sort of capacity utilization levels would your plants be operating at right now?
65 to 70%,
Okay.
This is where we are operating.
Okay, got that. Now, in that context, obviously there's just so much happening in the sector, right? We discussed Birla's. You in the past have told us that if it's the right price, if it's the right strategic fit, then you'd also consider Axo's India assets. Where is that? I mean, they've started that formal process, but have you entered into any discussions?
No, we haven't. So we found the valuation to be on the higher side, so we dropped out, of the race. At the stage, when they wanted more serious discussions. So as of now, we are out. But in case there is an opportunity which opens up later, we may again look at it seriously.
You found the valuations high, at least in the first round, so you're not interested.
That's right.
Just one question. Morning, Sir Prashant here. Oil prices have come off very sharply. And I think 40-50% of your raw material cost comes from crude oil derivatives. Could you give us a sense of how this is likely to, if prices stay here and maybe even head lower, as is widely expected, will that provide a margin fillip to you? Give us, if you can provide us with some numbers here going forward?
Prashant, it depends. It's not that high, in terms of the oil impact, because direct oil impact is in the solvents and then on the monomers. These are the 2 products where oil impacts, the prices. And, there are other factors like, the demand supply situation, how much of supply is there in the market. So a lot of other factors come into play. It does impact, some softening will happen, but it doesn't get passed on immediately to our raw materials and then on to finished goods, because we have inventory, which takes time, therefore, to liquidate. So if it comes, it will come more towards the first quarter, unless the prices again start rising, because these things are very unstable. You never know. Now it has decreased. 2 months back, it was increasing.
Abhijit, Mr. Roy, while we speak about margins in your business as well, while we speak to you, we also speak through you for the industry. There are murmurs of a lot happening at the leader itself, because the leader has lost some market share. You have a significant competitor. All of that, you've been gaining market share. Is there anything that we can hear from Asian Paints? Is there any market chatter that you have picked up?
No, I can't comment on what they are doing. I would like to focus on my team and our company. So we are relatively very stable. We have a good stable team here. We continue to therefore, perform in the market, continue to grow. So that's all that I can say. I don't think I am in a position to comment on competitors like that.
All right, take that point. Thank you so much, Abhijit. Always a pleasure speaking with you. Wish you good luck for the 4th quarter and the quarters coming ahead as well. Take a short break, come back. On the other side, we have the management of Shriram Finance joining in, as the company has raised over 300 million from development financial institutions.
Welcome back. Just a quick check on the market before we carry on with more corporate conversations. Market's holding actually quite nice and steady, 160 points up. So that opening gap has not been sold into. In fact, we are trending at the highest point of the morning so far. So it's looking really good. Financials are leading and the Midcap index is also doing very, very well. It's a solid Tuesday morning of trade. Well, speaking of financials, let's put the spotlight on Shriram Finance. There was some fresh developments at the company, which they shared yesterday. The company has raised over $306 million from development financial institutions. To talk about this and, of course, to discuss the overall business environment, we have Mr. Umesh Revankar, Executive Vice Chairman at Shriram Finance, joining in. Mr. Revankar, always a pleasure having you on the show. Thank you so much for joining in. So I was going through your press release that came in yesterday. This is an external commercial borrowing, and you've got a lot of marquee institutions who've chosen to participate. So congratulations on that. But what does this do to your overall borrowing cost? Just give us a whole mix. How much is local borrowing? How much is overseas? And at what rates did you pick up this financing? What does it mean for overall cost of finance?
Yeah. See, basically what happens is overall, if you look at my total liability side, 24% is the deposits. We are deposit taking NBFC, and the bank term loans are around 20%. Then we have a securitization done by a bank on the priority sale. That's around 18%. The external commercial borrowing, ECB loans and bond put together, it's around 18%. So overall, we would like to keep around 20% each. Around 20% is the capital market from the capital market entities. So we would like to have 5 large sources with around 20% each. That is the strategy we have. External commercial borrowing, especially if it is a loan, normally comes at better rate because development institutes, when they participate for a social loan, we are able to get a better rate. So landed cost will be less than 9%, around 8.5 to 8.6, I can say, with all hedging cost added. So we hedge all international borrowing in the bond market or even the whatever we raise in dollars.
So you're saying that the total cost of this new loan that you've raised is 8.5 to 8.6, including hedging. Now, we're anyway in an environment which has become a little more easier for NBFCs, right? The risk weights that were hiked, they've been rolled back. The RBI has been pumping in a huge amount of liquidity in the system as well. So overall, in the last 2-3 weeks, what's the easing in liquidity conditions? And give us some sense of also what that means for your margins as you look at Q4 and then Q1.
See, Q on Q, if I look at for incremental borrowing, then 10 basis point, there is improvement, that is lesser. So to that extent, yes, we have the margins a little expanded, but I cannot say that it will translate into total what you call margin improvement. We need to wait till the quarter end for getting the numbers, because typically in the month of March, we also do large new vehicles, and new vehicle lending will be at little lower rate. So it may not have a big impact on net interest margin, but yes, it will be positive, definitely, better than the previous quarter. But going forward, I feel the liquidity situation being good, and as you rightly put it, the risk weight, there has been changed by the regulator, and the banks would be passing on some benefit to us. Immediately, you don't see that in this quarter. But going forward for next couple of quarters, I see bank translating that into a lower cost for us. That will help industry as a whole.
So just reiterating, you're saying you've seen 10 basis points improvement quarter on quarter in your cost of borrowings, and NIMs overall Q4, I mean, you see a favorable move. Just a last question, sir, on growth itself. Just tell us in terms of AUM growth. And the reason I ask you this is that there's a debate going on in auto financing. I mean, there are some analysts that are saying that the reason why two-wheeler sales are falling is that financing has become a constraint. But large OEM makers like Bajaj Auto say that's not really a concern. You tell us, you're in the lending business. Is there any constraint to financing of CVs at the lower end? CVs, used PVs, two-wheelers, etc.
No, two-wheeler especially, third quarter is always a large, and fourth quarter will be lesser than the third quarter. That's every year, because third quarter being the festive period.
Right.
So we can't compare between the third quarter and the fourth quarter. But we have not seen, compared year on year, we have not really seen any negative growth. It is a little flat. It has not grown big, yes, because there were some geographies where
Mr. Revankar, no, point taken. Thank you very much for joining us. Good to have you with us here. Yashish Dahiya is now joining us. He's our next guest, Chairman and Group CEO at PB Fintech. Mr. Dahiya, good to have you with us here. Good morning. We spoke early February extensively about your plans for the healthcare foray, and that foray is taking shape. You're investing almost 600-700 crores in the business. Could you let's start with that. Tell us a few things. When will this venture be rolled out? You're setting up some hospitals, subscription-based. And will there be further investment? You've said you'll bring in outside investors as well. Will you be putting in more money? When is that going to happen? And then tell us, there have been some concern in the market that the focus here is not profitability. At least that's the view of some analysts that I've spoken to. If you can clarify on that as well. Go on, sir.
Sure. So, sorry about that. Essentially, what's happening is we have about 4 crore people in India who buy health insurance. And what we are creating is a facility for the health insurance industry, which includes everybody who has a health insurance to have essentially their own family doctor who advises them on what's the course of action they need to take. This person is not incentivized by how much they get treated or by what operations they have. This person does not make a referral fee. And what that implies is that this person can be fairly unbiased and be like a friend to the consumer, and thus advise the consumer on whether they need to go to a hospital and which kind of hospital is right for them. At the next level, there is a network, which is a narrow network compared to the wide network that exists today. The wide network is about 14,000 hospitals in the country. You may select a small percentage of them, whatever the number be, 200, 400, 500 hospitals. And these are the hospitals where these consumers can go. And as long as they go there, their experience on the claim side is made very smooth. That is the whole approach. Now, out of this network, in one particular city, we would own that network. And the reason for doing that is principally to make sure that the experience from a technology perspective, from a consumer service perspective, is built to a different level, which we envisage can be a game changer for the consumers in terms of their experience. And then perhaps once that is proven, to roll that out across the network per se. Now, when you talk about PB Health, it is there is an investment going in of about 2,000 to 2,500 crores from various investors. Many of them are pure financial investors, and they have no reason to invest except for the financial return they expect to make out of that. I don't think it is for everybody and anybody, for the entire market to agree on what is the return they expect from that. They believe there is a return, that's why they are investing. A bit like when InfoEdge invested in Policy Bazaar way back in 2008. Many people believed it was not a great financial investment. They have made about 100x return.
Yeah.
So I would say let them who are putting their money be the best judge of whether putting their money is worth it or not.
No.
Yes, you are absolutely right. From a PB Fintech perspective, it is not just a financial investment. From a PB Fintech perspective, the fact that the health insurance customers get a better experience helps the industry do better and helps PB Fintech, which is a large, player in the health insurance industry, do better. And so clearly we have a bias, strategic reason to do this beyond the financial investment. But that does not mean that is the case for everybody. A lot of the investors coming in are pure financial.
No, I completely agree. But the only thing is that PB Fintech will have about 34% stake, right, in this entity.
Yes.
So you are kind of the prime driver. So if
So by the time, I think by the time round 1A and 1B are over, because it's done in 1A and 1B, I think PB Fintech would be down to about 25, 26%. And from a strategic perspective, because I know who the other investors are, I do not believe PB Fintech is the long-term strategic driver of this project. It is at best an incubator and a catalyst. It is not the long-term owner of this project, and nor is it the long-term driver of this project. At least two of the investors coming along are much more in that category than PB Fintech.
Can you tell us who are the other investors?
I have confidentiality. Like in any agreement, you cannot disclose people till the deal is done. And that is a pretty obvious thing. I don't know why people want to know that before the deal is completed. And the deal cannot...
So you're saying after the second round of fundraising, your PB Fintech stake will...
It is after the first round is complete, which is 90 days after the shareholder agreement is signed.
Right.
PB Fintech would be about 25%.
Okay, so PB Fintech stake will be down to 25%. That's an important point. You're saying for PB Fintech, it is not purely a financial investment, but one should not assume that, I mean, there are outside investors who want a return on their investment. So
I would hope so, unless they don't like their money.
But, and you're saying, no, the only problem is that you right now also said that for PB Fintech, it is not. So 25% is also a significant stake, and you are the man driving things, right? I mean, people are betting on you, Yashish. So when you say that financial return is not the sole driver, the sole motivation for this, hence that question. That is the only thing.
Let me explain. Financial return is not the sole driver for Policy Bazaar either. The primary objective of Policy Bazaar is to grow insurance penetration in India, specifically in health insurance and term insurance. And that's why it takes us 14 years to have broken even. And yes, we will make profits as well, like we are doing right now. But that is not the primary objective of our business. The primary objective is the purpose with which it is set up.
Absolutely.
No. For PB Health, the primary objective is giving the customer a great experience, making the insurance smoother. The primary objective is not to just make a profit.
Sure.
For any mission-driven business, your primary objective is not always to drive short-term profits.
No, absolutely. That's a very sort of noble, way of looking at it. But just to get back to some specifics,
I can't see another way to look at it.
Now, the thing is that there are also shareholders, there are public shareholders, so we have to ask you the profit questions as well. I mean, that's the compulsion from our side. So just to go back,
the public shareholders have got enough information to make a decision, which they have to make over the next 25 odd days on whether this is a good project for them or not.
Absolutely. So Yashish, just to
do it, and I don't think the profitability of this particular venture should be the primary decision maker for them on whether they need to invest or not invest.
That's an important point, and thank you for being candid enough to say that for shareholders, they need to think beyond profits as being the primary motive when they're coming to that decision. But just let me get to the specifics. What you're saying is that over the next 90 days, by the time the first round is over, PB Fintech's stake in this entity, PB Health, will come down to 25-26%. That's point number one. Since and for how long do you foresee PB Fintech holding at least this 25%? I heard you. You said over the long term, PB Fintech will not be the owner and driver. So for the foreseeable future, 2-3 years, do you expect PB Fintech, the listed entity, to continue holding at least 25%?
I don't know. PB Fintech, as of now, I don't envisage PB Fintech investing anything further. Now, what that means is, if 1 year down the line we raise more capital, PB Fintech is not participating, so of course it will get diluted. How much we will raise, I don't plan things to that level of detail right now.
Okay, sure.
Right?
Take that point.
For the first 3 years, But that does not mean we will not raise more capital.
Okay. Okay, fair enough. So there could be further dilution, but you don't know how much and when at this point.
Yeah, at this point, I do not envisage PB Fintech ever having to invest again. Now, that is not a commitment that we will never invest. But what it means is I don't actually envisage it. I don't see it.
You don't see that need. You don't see that need at this point. Now, I must ask you the question of some basic assumptions, because like I said that, as of now, there are public shareholders and they will have to decide whether to sort of participate in this or not. For their sake, just some estimates, because you would have done some basic homework. This kind of an investment, I mean, what is the kind of IRR, ROI, what is the kind of profitability margins? I'm sure you and the teams have done some basic math around this. If you could,
I think there's a 50% chance the project will fail. There's a 50% chance it might succeed. If it succeeds, it'll be very big. In a way, when we started Policy Bazaar, how much projection did you want me to make in 2008?
Right.
I, of course, have a projection. And I have shared that with our board. And we have shared some of the things with our own shareholders in terms of why we are doing this project.
Right.
We have also shared it with the other financial investors. And I don't think, for a private company out there, we are going to put, our projections every year out there. We don't even put projections for Policy Bazaar or PB Fintech. You do appreciate, right? I don't even disclose what our profits next year are going to be for PB Fintech.
No, we understand that, but past has it, and you said that shareholders have enough public information to make a call on what they want to do with their investments in PB Fintech.
Yes, and I'm clearly saying there's a 50% chance the project will fail.
Right. We take that point. And, apart from just this foray, there have been concerns around growth for your own core business as well, as there have been for Paisabazaar too. Though there have been, yes, please go ahead.
Your fear on the core business. In the year of the IPO, we did about 5,000 crores of premium. Right? This year, the core business alone, outside of POSP. So we are doing 23,000 crores. Let's say 5,000 crores is POSP. That's 18,000 crores. How much growth do you want? Is 5,000 to 18,000 not enough growth? In 3 years.
We get that, but it has to be relative to the industry as well, right? The street is betting on you growing.
Industry, my friend.
1.8 to 2 times industry is what the street is penciling in.
Yeah, I think it's about 3-4 times the industry. If you really do that math. From 5,000.
And you believe that you will continue to grow at 1.8 to 2 times?
What is that?
No, you believe that you will continue to grow at 1.8 to 2 times industry?
I don't think we give projections in that manner. I hope that we do grow faster than the industry. But all I'm saying is in the last 3 years, we have grown at about 3 to 4 times the industry.
Okay, and what about the disbursement growth in Paisabazaar?
Over the last 3 years, that is also the case. However, of course, during last year, there was a credit squeeze. So the disbursal would have gone down. That is obvious.
Have you seen signs of improvement, and do you expect them to improve?
Month on month, we are seeing signs of improvement now. I think if you were to think about it, maybe November was the lowest month. And since then, month on month, we are seeing signs of improvement. But I don't think anybody was, on the unsecured business side, able to display, significant growth as a market till November. But yes, now we are seeing signs of easing and signs of growth. Plus, the secured business has grown very well.
Yashish, by the way, I must say, Prashanthi, I love it. 50% chance success or 50% chance of failure. But, I think only you can say it and get away with it. You build the business,
right? There's nothing to get away with it, my friend.
No. I mean it as a compliment. I don't mean it in the sense that, I started by saying investors are betting on you because you build that business. And you said, and towards the tail end, you said if it succeeds, it'll be very big. So I think point taken. Just a quick thing, Yashish. When is this
what we are attempting to do is a very big change in the market.
Correct. Absolutely.
What we're attempting to do today, when you go to a hospital, a person at the back of the mind thinks, why is this operation happening? Is it because the doctor or the hospital is making money from this?
Yeah.
Right? Yeah. And it's a very big, serious problem.
Yeah.
So there are reports out there of various sorts, right? But let's not go by that. We're trying to solve that fundamental problem. Without that, how will the middle class have health insurance? How will it work?
Okay.
Just to complete that loop on the healthcare business itself, we take your candor that 50% chance of it failing, etc. What I just want to understand is your rationale of currently valuing it at close to around 2,100 crore? What
No,
went
we are valuing
into
it at
that?
zero, my
Yes.
friend. Again, you are getting it wrong.
No, the amount that you've put in versus the stake that you've got.
Please
Yes,
hear me out.
okay.
Please hear me out. There is cash coming in of 2,500 crores odd. The valuation is 2,500 crores after the cash comes in. There is something called pre-money and post-money value, very important for your, readers, because all of them are not financially very savvy. The pre-money valuation is zero, absolute zero.
No,
Okay, there is no premium.
No, the
Everybody is coming in
equity.
at cash. 2,500 crores of cash is coming in. I'm saying the process.
Yes. Post
And
money
the
is
value
absolutely.
post the investment is 2,500 crores. So
Absolutely.
if I put
Point taken.
500 crores, I have 20%. It is as simple as that.
No, so which is what we wanted to understand. What was your rationale for giving 20% for that 500 crores as against 100% or 80% for that 500 crores, or as against say 10% for that 500 crores?
Everybody is coming in like an equal partner, putting in their money to buy the share.
And
The company is being set up from scratch. There is no value attributed
Absolutely.
to the concept or to any other thing out there, right?
Yes.
So it is
Yashish, before...
unlike a typical
Okay.
thing, and I want to be
Absolutely.
very clear about it. The company is valued at the cash balance, nothing
Correct.
else.
Correct. Now, before we run out of time, because I want to ask a couple of other questions as well. So our colleague Yash did a story recently, very important story, on the regulatory front for your main bread and butter business, saying that the regulator, IRDAI, is not happy with general insurance companies, general and health, on how they have managed the EOM, expenses of management. Within that, what they're saying is, well, commissions actually have been very high. And, the regulator has communicated that unless this is brought down, there could be a cap on commissions. I'm sure you've seen the story. It was put out recently. I just wanted your thoughts, Yashish. How do you think about this? And how, if there were to be a cap on commissions, how will this affect your business? Because that is bread and butter. Go on.
See, our take rate is about 16%. That's the total revenue we make divided by our premium. Okay. The expense of management is at 30% in general insurance and 35% in health insurance. Besides that, this is a very large topic. It is more for the regulator to decide than for me to comment on. The regulator is the principal of this school. You are asking the prefect or the student to comment on the principal.
No, but will your business be
unfair?
Will your business?
The regulator in their wisdom will decide what is right.
Yeah.
All I'm clarifying is we are at 16% and the expense of management limit is at 35%.
No. The point is the regulator is saying EOM is OPEX plus commissions. They're saying you've cut OPEX but not commissions. The way you manage that EOM number is by doing this. But commissions are high. Commissions have been climbing. So bring that lower. And hence the question, Yashish.
Yeah, so I think it's for the regulator. I don't really have a view on this, my friend. It is more for the regulator to decide. It's a bigger question than, I can answer.
Okay, Yashish, so to circle back to where we started, and since we've spent so much time, trying to make sense of PB Fintech's interest in PB Health, just leave us with some timelines now. The cash has been coming in, you're getting in the investors. When does the business come off the ground? And just remind our viewers once again, while you're talking about experience.
I just wanted to clarify, the cash has not come in yet. The cash will come in over the next
commitments are in.
Days.
Yes, the commitments are in. So therefore, what are the timelines? No, absolutely.
I just wanted to explain. The money will come in by July end.
By July end, the money comes in. And then what are the timelines to get this network up and running, the better experience you're speaking of?
We should have an operation ready, some sort of an operation ready by about December, which is about 5 months after the cash comes in.
And by when do you decide that on which part of the 50% are you? 50% success rate, 50% failure rate? Is there any timeline?
I think we will know in about 4 years' time.
All right, 4 years' time. Okay.
All right. Well, Yashish, but we look forward to many conversations over the next 4 years, and it's always interesting speaking to you. We wish you all the best of luck as you build out that business, and I'm sure it'll be a success. It's not 50-50 with you at the helm. Thank you very much for joining us, and look forward to our next one. All right, that's Yashish with his perspective on the business, the underlying business, of course, the healthcare foray as well. We'll take a quick commercial break here. Manisha will be focusing on the commodity space. Stay tuned, coming up.
All right, welcome back. Well, the equity market's been holding up quite nice and steady. Let's figure out what's happening in commodities. We have Manisha with the latest. Manisha, so what's the headline there today?
Well, I want to look at metals really, Survi. On top of my list clearly is gold, because the kind of run-up that we've seen into this one has been unstoppable. Last year was 28% of gains, and this year we're already up by 15%. We are trading above $3,000 an ounce, and last time I saw was $3,012, and we still are running on the higher side. The latest trigger really came in from the weak US data. Every number that's come in the last 24 hours, whether it has been about retail sales, new home builders, New York manufacturing contract, all of that came in on the weaker side. That has been supportive. And the inflation numbers were higher. Remember, the US Fed meeting starts today for 2 days. And ahead of that, we are looking at buying coming into the space. OECD report that came in yesterday also has cut the global growth forecast. That's supporting the markets there. And then US also has launched some airstrikes on Houthi, men at rebels in Yemen. That has been yet another the geopolitical tensions that seem to be supporting the prices as well. That's about gold. Silver has been trading on the higher side as well. And when you look at within the industrial metals, copper is your space to be because we've seen prices gain 1.5% overnight. Copper prices are up 25% in this year already right now. If you look at the US copper prices, they are much higher and are trading at a 10-month highs with a premium of almost $40 to $60 a ton. And when you look at the LME copper prices, they are trading at a 9-month highs as well. Aluminum is yet another metal which has continued to do quite well for itself. We've seen prices trade at around 9-month highs. 5.5% up in this year until now. There is low supplies coming in from major producers. And for aluminum, it also is about Chinese markets where you are looking at exports muted, especially after those tax rebates were ended. Now talk about the US markets, and with 25% import tariff imposed, you're looking at US aluminum trading at a premium of $990 a ton right now, with 60% of a jump up in premium from the start of this year. The other metal on my screen also is zinc and nickel, where we are looking at multi-year highs onto those one as well. And major support coming in from the US dollar index, which is trading at a 5-month lows. There also are more expectations of stimulus coming in from China. And then we already have seen China come out with a plan on Sunday. The clarity of that is awaited. And then finally, it is going to be about the central bank meetings. You have the US Fed happening today and tomorrow. It's also Bank of Japan and Bank of England, all of them meeting in this week. So any statements, any changes from there also will impact the markets.
Okay, all right. Thank you very much, Manisha, for that. With that, we have to quickly slip into a break. On the other side, our special segment, It's the Economy. Lata today will be in conversation with Niranjan Hiranandani of Hiranandani Group and Gulam Zia of Knight Frank India to discuss whether the stock market downfall has led to any sort of a slowdown in real estate sales.
Welcome to It's the Economy. The Nifty Realty Index is the worst performing index in 2025 and even in the past 12 months. While the Nifty is down 4.2% from Jan 1st to today, and the Midcap index is down 14.5% year to date, Nifty Realty is down 23%. Likewise, on year terms, while Nifty and Midcap indexes are in the green by about 2 to 5%, as you can see. The Nifty Realty Index, so even in year-on-year terms, is down 3.2%. That's from year-ago levels. So is there any underlying slowdown that this fall is reflecting? More importantly, is the fall in the stock market hurting the wealth effect and thereby impacting real estate sector at all? For all these questions, I'm joined by two seasoned people. One is, of course, a seasoned realtor, Niranjan Hiranandani, and a statistician, if you please, a consultant, Gulam Zia of Knight Frank. Gentlemen, thank you very much indeed for your time. Gulam, I'm going to start with you because you gave me some data only on Bombay sales. Mumbai is not indicating much of a slowdown, but some pockets are. Can you take us through what you have found?
Thank you so much, Lata, for inviting us on this show. It's always a pleasure talking to you. And since we're talking data, and since specifics are coming in from Mumbai, let's talk about what's really the trend across various layers of markets. When we're talking about the topmost market, and that's something which everybody's talking about, that last 3 years, the market has been completely driven by the luxury sales and premium apartments selling like hotcakes, etc. So that's one segment which is in any case doing well, but that is obviously largely dependent on the wealth creation on equity markets. And that segment, the super premium, when you're talking about, say, 50 crore plus kind of a category, is actually going on as usual. In fact, the number of sales I've shared with you last 5 quarters, there is hardly any slowdown there. But the worry is actually in the immediate next slab, which is 10 crore to 50 crore of segment, is showing cracks. And why is what I will try to explain. Because if you look at the inventory that has piled up in that segment is dangerous. It is going to take at least 4 to 5 years to absorb that inventory. In the upper end, only 2 years to absorb all the inventory existing in 50 plus category, 50 crore plus. But the 10 to 50 crore category is where there is a lot of sweat already. And the category which is below that, which is below 10 crore, is once again showing not more than 2 years to 2.5 years to absorb. So when you're looking at overall situation, it is that segment which is already showing cracks. And while anecdotally, if you're talking to many of the stakeholders, they are talking about slowdown, no inquiries, no conversions, etc. But all of them are just lead indicators for me. The data says barring one category, which is 10 to 50 crore, in other categories, it is not much of a sweat. So overall, that's Mumbai number. But when you're looking at the other cities as well, while Pune and Mumbai are still looking...
Okay, we'll come to that. Okay.
Sure,
no,
sure,
I'll just come to the... I'll come to the cross city in a minute, but just wanted to explain the data that we have been showing. What Gulam Zia is saying is that there is only one category above 50 crore, which in year-on-year terms has shown a lower growth of 22%. But even there, quarter-on-quarter, this quarter is better than last quarter. Likewise, if you look at the pile-up of inventory for the 10 crore to 20 crore houses and 20 crore to 50 crore houses, you need some 4-5 years to clear out the inventory. But for the topmost category, you need only about 3 quarters to clear out the inventory. That's the point he's making. Mr. Hiranandani, your thoughts. Is the stock market wealth effect hurting at all or not at all? Demand is good.
Lata, the stock market fall always hurts because everybody has some investments into the stock market, so they always feel unhappy about that situation. So I think it's more about the feel bad factor rather than the feel good factor, which would happen when the stock market is going up. But on the other hand, I don't see a reduction in terms of demand interest in the real estate market at all. So the kind of inquiries that are taking place, the closures that are taking place, and the demand potential that has happened is in fact going up. And that is exactly what Knight Frank's report, which Gulam has presented, is actually indicating a quarter-on-quarter increase as far as property sales are concerned. The only segment which worries me is actually the affordable segment. and not the higher segment. The higher segment demand, interest, and other thing has gone up, barring the sentiment that you are talking about, which always will affect any sentiment which is negative. People will kind of feel, oh, should I buy now or not? But on closures taking place, I still see things are going as they were. In fact, the inquiry is quite high and strong, and they're still continuing to grow. Except affordable housing. Affordable housing is a very big challenge. And I'm a little worried about that segment of the society because, you know, the taxation and other issues have really created a problem in that segment. And I don't know really how the government...
You define affordable as under 1 crore or under 50 lakh?
Under 50 lakhs is the government's definition. So I go by that definition, no?
Okay. Okay.
So I'll stick to the definition which government has given, Reserve Bank is giving, all the other agencies are giving, PMAY is talking about 45 lakhs. So 50 lakhs and below is very challenged, but all the other segments are still, demand is growing and we still see closures taking place. I don't see a problem in the short run.
Okay.
In the long run, if the market collapses...
Mr. Hiranandani, 1 minute. Ghulam Zia's data, which you are aware of, is showing that 10 crore to 20 crore, 20 crore to 50 crore, or rather 10 to 50 crore, it will require about 16, 17 quarters to clear out, which is about 4 years. You're not worried about the inventory pile up in that 10 to 50 crore bracket? Won't that push down prices? You know, along with inventory, you also have a stock market which has not been exactly exhilarating. Would you worry that in that sector prices may fall?
Of course, there is a possibility because if there are a lot of branded players and unbranded players in the segment who have got into. So I think many of the unbranded segment is challenged very much, and you will see there's a skewed situation. The branded players are able to make the sales, and the sales are much faster, and the stock available with them is smaller and shorter. Okay. But if you're seeing people who are unbranded, who have come first time into this segment and are trying to get into the market, obviously the sales will take a longer period of time because these are not the people whom the people recognize as regular players in that segment. So while we talk about it, if you look at the kind of sales that take place with the branded builders, whether it's in Mumbai or you saw it in Delhi, in both the places, the sales in the branded segment is strong, very strong in fact.
Okay. Ghulam, I'll come to the affordable housing. Okay, let's discuss that first. Would you equally worry that affordable housing is a problem? Is it a sales issue? Is it that people are not interested in that segment because the profits are thin?
Absolutely the case, as you said, Lata. The problem with affordable housing, and just to take you 4 years back, or 4 to 5 years back, COVID and pre-COVID, affordable housing used to be almost 2/3 of overall sales in the country. I'm talking about top 8 cities. And that today has shrunk, that pie has shrunk to actually just about 1/3 or even lesser in many markets. And that's a big worry. And that's a big worry only because that in that period, at least there was a transition from Pradhan Mantri Awas Yojana 1 to Pradhan Mantri Yojana 2, which started in October 24. And that's where the new segment has opened up for affordable housing, but supplies are just not there. Developers are not coming on to affordable housing purely because the margins are low, and you will require much more efforts to sell in that category because right now what is selling is mid to upper end. So obviously it is simple economics, commerce, they're all here to make money and quick money, of course. And hence, developers have actually been ignoring the affordable housing completely. And that is what is supposed to hurt in times to come when things change. That rental, the interest rates are now climbing down. So that segment is expected to come up, but there is no inventory there.
Okay. Very quickly, Ghulam, city-wise, you gave us Mumbai data. You were telling us about the cities that are doing well.
Yeah, in fact, it's Pune which is breaking all records. That's one of the top 8 cities which has actually not showing any impact of any kind of slowdown anywhere in India or abroad. And Hyderabad is flattish, but the ones which are really hurting are Delhi and Bengaluru are the 2 cities which are showing clear signs of slowdown. The sales are actually looking impacted. Chennai is showing slightly better performance, but on one end you have Pune doing excellently well. On the other end you have Bengaluru and Delhi which are not doing too good.
Okay, Mr. Hiranandani, would you want to add to that? City-wise, is there any spot of bother and any spot of satisfaction?
On the higher segment, I don't see a problem. But what Ghulam is saying is correct. You do see problems which are taking place in pockets. Lata, that is the case which has always happened.
Yeah.
In good times also, there are segments where you will see slowdown. There will be oversupply. There will be temporary reduction in demand. You can't have it